So I'm Kevin, General Manager and Head of Syfe Hong Kong. Prior to joining Syfe, I was the APAC Digital Head of Engagement in Shoulders APAC, right? And today we also have Samantha, our Chief Business Officer from Syfe. She was the ex-managing director from Block Peak Investment Advisor. She managed multi-billion dollars hedge fund in the past. And we have Archit, our head of investment in Hong Kong, group head of risks of Syfe. Prior to joining Syfe, he was the head of fund derivatives and quantitative investment strategy. Yeah. And we also have Neil, senior member from BlackRock ETF and index investing investment strategy team in APAC. And we have Andy, global portfolio manager from LW Asset Management. And I think some of you may recognize Andy from a lot of the finance media, right? Like Bloomberg and different like TV, Now TV, right? He's been a guest from these. And welcome everyone to the Outlook event. We have a very exciting agenda lineup. So first up, we will have Sam sharing more about Syfe, right? Some of you may not know Syfe. Some of you already are our client, right? We'll start off with our introduction, and then we'll go into more from Archit. We'll share more the insight from 2023, yeah? And we would then have Neil sharing the market outlook in 2024, and Andy would do a little bit of deep dive into Hong Kong and China. Then we will bring everybody back in the panel, and then we can discuss. So again, just a reminder, if you haven't scanned the QR code, or go to Slido, right? Get on there. There's a poll going on. We are also having all the interaction and questions there. All right. So without further ado, let me introduce and welcome Sam on the stage to share more about Syfe. Thanks.
Thank you, Kevin, and thanks everybody for being here, and especially to our partners, BlackRock, for hosting this event with us today. So I'm going to keep this relatively brief, but I will share a little bit about Syfe and why we're here and what we do. So we are a digital investment platform with a mission to empower people to build their wealth for a better future. So really focused around long-term investing and a holistic investment platform that meets all the needs of retail customers. So to give a little bit more background, and I'm not sure if you can see the screen, so I'm going to go to the side. So we manage over 10 billion Hong Kong dollars. We're operational and fully licensed in 3 jurisdictions. So we started in Singapore. That's where we're headquartered. We started 4.5 years ago there. And more recently, over the last year, we have opened in Australia and obviously in Hong Kong here today. So to give you a little bit more idea about what we do and the broad offerings of Syfe and why I say we're a holistic investment platform and really the first in Asia to really cover the 3 main pillars of wealth, right? And those would be firstly cash management, so managing your daily liquidity needs for short-term investing and optimizing the cash, basically the cash that you could put in the bank for a lot less. But we offer money market funds and various other products for your daily cash management solutions, right? Then where we started actually is in our managed portfolios, and where this is a big passion of mine and many people in the team, where we've come from institutional backgrounds, and many people always used to ask us, me working in a hedge fund, what should I do? What should I invest in? Where should I put my money? And I'm sure many of us in finance get asked that many times. What should I buy, etc. And now, I think there was always a big question about there's even people in finance would ask me that question. And we really wanted to create a solution where, we could really tell and help retail investors more holistically and be basically diversified and have a well-managed portfolio that if you didn't have the time, maybe you even had the expertise, but you don't have the time to manage it actively. And I can tell you, even though I've done this for a living for more than a decade, my PA investments have definitely underperformed my Syfe portfolios because I just can't look at them anymore. And I just don't have, you don't have the access that many institutional clients, many institutional investors have. and really the playing field for retail customers is completely different, right? So by having these managed solutions, by with professionals like Syfe at really low costs, we can create those solutions for retail customers who want to build their wealth for the long term, as I said, right? We also use multiple different underlyings for our products. So we, in Hong Kong, for instance, actually do direct indexing. So to keep costs really low and optimal for retail customers where we can, we do direct indexing. We also use ETFs and funds where we see the optimal use of underlyings for the best outcomes for customers. We also have our brokerage arm. This is actually live in Singapore and Australia, not yet in Hong Kong. So when I say this, it means that you have your short-term cash solutions, your managed portfolios for people who don't have the time, don't really want to take care of their daily managing of their wealth, but also the brokerage solution for investors who do want to do some of that and they want some more customization and personalization. And where we really see the future of investing is that you will essentially have buckets in all these three, right? So it doesn't mean that you have a managed portfolio and you don't have a brokerage account. You don't want to buy your Alibaba maybe or your Teslas and so be it, right? But you have maybe the bulk of your investing in your long-term diversified portfolios or income portfolios, whatever the case may be for you. But then you do some dabbling on the side. So just a little bit more on kind of the three pillars that I touched upon a little bit there. But so we have over 100,000 customers on our platform in Singapore alone. And to give you a little bit of idea of the scale, that's actually around 5% of the Singapore population, right, who use Syfe. And we focus on the three A's, although there is an E here instead, but it means the same thing. So access in terms of the products that we have, giving the best curated list of underlyings for customers to choose from. Expertise in terms of basically bundling those together and again building solutions from a technology standpoint that can reduce the costs for end customers, and obviously that means affordability in the end. Just a little bit on the timeline. I've touched upon some of these things, so I'll just say we obviously launched in Singapore in 2019. We launched our brokerage also in Singapore in 2022, and launched in Hong Kong and Australia last year. And with that, I will hand over, I think, to Archit.
Thanks, Sam. Okay. Again, a warm welcome to everyone. So I think we'll go into now the global outlook, probably in three parts. I'll cover a quick rebound of 2023, how it went, what we learned, what were the moving parts. Neil from BlackRock will go into more macro outlook for 2024, followed by Andy going deeper into Hong Kong, China, closer to home. So I think, 2023 was a year which kind of defied all market expectations. I think most of us in the investment space thought it's going to be a volatile year, more towards the downside than the upside, with expectations of Fed aggressively increasing the rates, which really happened. But I think still, and of course fueled by the whole generative AI, ChatGPT technology boom, the markets rallied and ended up close to like all-time high in the US. This effectively gives a quick snapshot of the key events that happened over the year, starting with, again, China finally reopening, the gates removing the kind of the zero COVID policy, which created that initial rally to the start of the year, but then soon was basically hampered by the regional banks in the US getting collapsed, with the famous one being the Silicon Valley Bank. But I mean, even those things kept the inflation pretty high, which meant the Fed continued on their path of aggressively hiking. People were expecting more, that Fed will pause around 5, but they continued until 5.5. And effectively, again, what changed the game was the launch of GPT-4 towards the Q2, rallying, making effectively the Magnificent Seven, which we all know about now, creating that, and that led to the entire rally of the market. Now, this is a snapshot again. I mean, like pretty much all asset class other than commodities performed pretty well. The positive correlation between bonds and equities continued from 2022 to 2023. I mean, this clearly shows, I think, the need for staying invested for people who were sitting on a pile of cash, expecting market uncertainties, doing a lot of tactical allocations, probably got suffered and missed out on the rally. Kind of definitely shows the need to stay invested, think long term, and obviously the more popular 60-40 portfolios make a comeback and still performing well this year. Now, I think going deeper into the equities part, as I was saying, the Magnificent Seven has an astonishing more than 70% performance last year. The interesting part, if you remove those 7 from the S&P, the remaining 493 companies accounted for like 12 to 13% performance. So clearly shows, I think, what drove that market last year, what changed that sentiment. And again, if you missed out, you missed out. Now, I think this opens up a real interesting question around like effectively how is the index investing and whether it's really kind of the way to go in the longer run. And especially, like, I think within the S&P 500 now, those top 10 companies account for like pretty much all-time high of more than close to 30% of index weights. On average, it has been over the last 3 decades around 20%. So that concentration is increasing. Now, obviously, not to say the large caps may not continue that ride, but definitely opens up the question whether we should look for more diversification across those things, and if the markets turn around, whether there's enough cushion to cater to. Now, in the fixed income space, I think it was a pretty interesting one. With towards the start of the year, the bond yields started. This is the 10-year Treasury yield. Started around 3.75. Touched in around October, touched like a 15-year high of 5%, with the entire higher for longer push from the Fed. But like as inflation or the disinflationary trend continued, we saw quite a quick reversal in November and December, and the yields ended at around 3.9%. Again, means one of the things again to highlight that, as I think Sam was also trying to say, if we try to times certain times, those things doesn't work. So staying patient, staying invested, still the key for long-term investing. Now, I think some of the next ones are what basically drove that resilience towards the first half of last year in inflation and US economy. I think 2 key things which I think like a lot of people would have heard about. One is consumption. I think consumption in general accounts for, at least in the US, more than 70% of their GDP. With like the pandemic push, a lot of, again, people saving higher but as the expenses goes lower with the government support, the excess savings reached a very long time high of 2.1 trillion. Now that, as that savings started to wallet out, over 2022, 2023, this made the economy quite resilient. And now, from this is the data from Federal Reserve Bank, most of that excess saving has depleted. So again, puts into a question of whether that consumption, which accounts for a pretty high weight in the GDP, is going to support the economy in 2024 or not. Now, the second one, again, labor market, which has been pretty strong in the US over the last few years. And I think there's an interesting fact that structurally, there has been a lot of people who are retiring, which effectively created those jobs and effectively made that market pretty strong. Now, as things stabilize, now, like we see that the trend in the non-farm payrolls, which is effectively a reflection of how many new jobs are created outside the farm and government jobs, is stabilizing, trending lower. Now, this could effectively be an early sign of weakness in the economy. Obviously, I think a lot of us have heard recent news about large tech companies doing massive layoffs. eBay recently last week announced 10% workforce. So there's generally a lag as the Fed, historically we have seen lag as interest rates rise. Always there's a lag in how the economy reacts and how the corporates react. Now, I think just to put it in a chart again around inflation, started pretty high, and like that this inflationary trend continued over 2023. The headline inflation and core inflation between 3 to 4%. But I think the key thing is it's still close to 2 times Fed target, still not there yet. So it is in the right direction, which I think made effectively the Fed pivot in a way, that the real pause happening towards the end of last year. Now the key question is how long the rates continue where it will be before really the cuts happening. I think in our perspective, the markets are pricing it too aggressively. We see, I think, close to like 90% people expecting like 4 rate cuts this year, and even like close to 50% expecting more than 6 rate cuts. So, I mean, it's to be seen, but I think in our perspective, that's a bit of aggressive pricing, and potentially things will stay longer as the lag effect continues there. Now, I think a quick kind of opening for Neil to go into the next session, putting down some questions which I think a lot of us would have in our head in 5 key pillar buckets, I would say. So US equities, like I was saying, like are large caps or the market weighted index still the play, or should we go more value, more quality, more equal weighted ETFs? Now, Hong Kong, China, something which Andy will cover later. I mean, obviously, I think good. We have seen some policy changes in the last few days, making some comeback. But nevertheless, it has been a tough 3-year ride. So has the market bottomed out, or how soon can we expect it to be? Generative AI, I think we cannot not have that discussion. So are the valuations justified? I mean, we obviously see NVIDIA even this year continues having more than 25 just year to date. So is the trend continuing? Is there risk in there? Then I think fixed income, this definitely will be an interesting space for this year. Probably giving better risk-adjusted returns, better risk-reward as genuinely Fed pauses. Now the key is how quickly the rate cuts will happen. Now one key interesting fact which I think all of us should care about is the geopolitical risk. I think this is a year where more than 40 countries are having national elections, including obviously US, India being the major markets. So, I mean, historically, it's an interesting study we were doing. I think historically, probably more than 90% of the time when US had an election, the markets ended up positively in that year. But I think that's a historical data point. So with that, I will pass on to Neil.
Okay, well, first off, I just want to say a big thank you to Samantha, Archit, and the team for welcoming us here at BlackRock to this event and your partnership and jointly hosting it with you. Our pleasure to be here. So they say when you give a presentation like this, just start with the headlines. If you don't listen to the rest of my 15 minutes, you'll at least leave with some actionable insights. So on that front, I think the question everyone has is regarding the US market. I mean, it just keeps hitting all-time highs. Every time there's a bit of pessimism, it just seems to go higher. So what do we think of it? Well, we're underweight, as you can see here, that pink box. We're underweight the US market. So we think that a lot of the recent optimism is predicated on some overwrought hopes of a soft landing and inflation really sharply coming down. That said, if you consider our overweight to the AI theme, the majority of these companies are beneficiaries are US companies. If you take that as a whole, our US position is closer to neutral. So underweight the broad index, but overweight the AI theme. Japan, you can see there the yellow box and the +1. That's an area we really like. That overweight speaks to one of the themes we have in our market outlook this year, which is a playing on relative valuation. So the fundamentals in Japan we think are good. Fundamentals in Europe, less so. And if you look at how those assets are priced, that leads us to overweight Japan and underweight Europe. Third theme we think is going to make good investments this year is harnessing the structural forces we see in markets. So, I mean, for instance, different growth prospects across different geographies. That's something which is tied closely to demographics and aging society. So on that front, we're neutral on China and emerging markets at the broad index level. And one of the reasons for that is the weaker trend growth that we anticipate in China. So that's equities. That's the stock market. Now let me turn to fixed income. Now, very generally speaking, our view here is based on the US fiscal position. So bigger budget deficits mean growing public debt. We think that's on an unsustainable path, and it ultimately leads us to believe that we're facing an era of higher inflation. That makes us more precise in the fixed income exposures that we like. So we're tilting to short and medium-term bonds. You know, bear in mind, inflation really is a bond's worst enemy. You're receiving a fixed coupon, the value of which erodes if inflation is higher. Perhaps I'll also come back to this theme of relative value. I mean, this is really getting granular, but these are all exposures which you can express via an ETF, so worth mentioning. Hard currency emerging market bonds, mortgage-backed securities in the US, both things we prefer over developed market credit generally, investment grade in the US, and high yield. And the reason for that is simple. The spreads are simply more attractive. So that's a pretty mixed bag of views. And it's because the macro environment that we face now is more complex than anything we've seen in the past 20 years. So that might sound like a bad thing, but actually we think it's good. Because for the first time in a long time, you're actually going to get rewarded for making the right calls, for being precise and being selective. I think before we move on to more on the investment views, it's worth setting the scene with a quick word about the US economy. Now, strong stock market doesn't always mean an economy that's firing all cylinders and vice versa, but I think in this instance it is worth considering because the forward-looking nature of the stock market does mean that it's often an indicator, leading indicator of the economic cycle. And a lot of the current optimism in the market is based on the idea that the economy is facing a soft landing. So all this talk last year of recession, no recession, inflation, no, is it coming down? Is it going up? Is it transitory? Well, the consensus now is everything's going to be okay. And one reason for this is that job growth since 2022 has actually outpaced what's normally seen in an economic expansion. I mean, that chart's a bit busy, but you can see the typical expansions in yellow. The one we've seen since 2022 is in orange, so doing better than what's normally seen. Apparently, we see a few issues with that, in fact. And this is something that often gets lost. We're actually on a weaker growth path now compared to what we've seen in the past. So normally you would expect the US economy to grow around 2.5%. It's actually only growing at 1.7% now. So while economic growth has been strong, it's because it's been catching up with the restart post-COVID. So zooming out, you're looking at that chart, it shows that the economy really is only just climbing out of a pandemic-shaped hole. So weaker output growth, weakening employment growth, at the same time when there's not a lot of slack left in the economy, bottom line of all that is going to be, we think, weaker corporate earnings. And as an equity investor, that's something which ultimately drives performance of stocks. So weaker corporate earnings is what we anticipate. This brings me to the second really important piece of context. It's going to take higher interest rates for central banks to keep inflation down. Why is that? It's because they're now pushing against expansionary fiscal policy. Fiscal policy is something which has become looser post the pandemic, and it's stimulating the economy. So interest rates are coming down, but not to the extent that we're used to. So weaker growth and higher interest rates. And that's going to make the macro market road ahead a windy and bumpy one. So, I mean, the theme we've got in our 2024 outlook, the tagline is grabbing the wheel. So you can make money, but you're not going to be on autopilot. You're not going to be driving down a straight road. There is no straight road ahead. And that's something which really contrasts with the last 20 years where, you could have bought a low-cost S&P tracker and you would have been absolutely fine. Now we think it's time to grab the wheel. Well, how do you do that? 3 things to bear in mind. Firstly, by managing your macro risk. Now I want to pause here just to really make this point. We believe higher interest rates are here to stay, and that's something that really differentiates the BlackRock view. It differentiates us from other asset managers and also the market as things stand. So it's going to require careful navigation in your portfolio because ultimately not all assets have adjusted to this reality. That's just a fancy way of saying the returns of all assets are not as attractive as they used to be when you compare them to cash. So the rate you get now for cash presents a higher hurdle for risk-taking. So bearing that in mind, we're careful when it comes to broad, static asset class exposures. But, that's where we also see opportunity to get selective and beat benchmarks. I mean, this slide just really reiterates my point. It's going to be harder now to beat cash. If you can see there, sorry, wrong slide. Yeah, here we go. Money market fund yields. You can see there, the green line, the red line, the yellow line. They've all spiked higher. So it's time to grab the wheel. Competitive cash is going to dim the appeal of these broader static asset class exposures. Okay, we've been over this opportunity to outperform by being selective and agile. Because of the weaker growth, because of the macro volatility, because of the higher rates I've just spoken about, we don't expect to see these sustained bull markets of the past. So you're going to have to be more dynamic in your portfolio. I mean, sure, there's probably going to be a period where everything goes up, but not for the same length of time as things previously. So the complexity of that macro picture means we're going to see more dispersion when it comes to expectations for asset prices. And you can see, chart on the right, new regime. I mean, the taller bars, basically what that's saying is you're going to be rewarded for taking a more proactive approach. chart says the same thing. There are real rewards for being selective. Your asset allocation is going to have to hinge on how assets are priced relative to each other. So I think that teases up nicely for a recap of some of our 2024 investment views. A year of meaningful repricing in bonds. So back to bonds. I've already mentioned we want to tilt to short and medium-term exposures rather than longer duration exposures. And while we're on bonds, yes, they may be back in terms of the income they offer. You can see here the latest is in orange. You're obviously getting a fair bit of a yield cushion now. But while bonds may be back, my colleague Andy sat here in the front row. He constantly reminds us equity's never left. So with that in mind, turn to the next slide. It's true they've never left. Returns have been good. I mean, Archit touched on this, the market really picking up in the second half of last year. However, we don't think equity prices yet reflect the higher interest rates that we're now looking at. So again, that's why we're underweight US equity indexes, broad indexes. The higher interest rates ultimately, we think, will drag on the valuations. They're going to put margins under pressure. They're going to erode corporate earnings, we think. But it doesn't mean we're shunning US stocks altogether. Like I said at the start, we're using the space that broad US exposures took up in the portfolio to tilt towards AI exposures. I mean, everyone here is going to be familiar with AI. You're all going to have heard the buzz. And I think that just goes to show that the complex macro doesn't necessarily mean we should just sit and wait. There are opportunities now that we can be taking advantage of. So that's AI. It also briefly touched on quality. This is an exposure that we saw a lot of flows into our iShares quality products last year. That's intuitive when you consider the macro picture I've just painted, with all the uncertainty, with all the sort of dimmer prospects macroeconomic-wise. You're going to want to own good companies. You're going to want to own solid balance sheets. And you're going to want to buy them at fair or good valuations. So quality is something we also really like in this environment. And quality is just another, quality exposure is just another way of getting granular with your US equity exposure. So we're really trying to get precise and find those securities across sectors and across geographies that are going to outperform the benchmark. I think sector-wise, healthcare is a really nice example because you've got solid long-term demand. Like I said at the start, some countries are facing aging societies. You think of healthcare, the growth is definitely there. It's also very resilient. If we do ultimately end up in a recession, you don't stop seeing your doctor because we're in a recession. So great characteristics at lower valuations in the broad index. That's a perfect case study of everything I've just been talking about. Chart on the right, I mean, we're just looking at US imports from emerging markets. You can see there EMX China, the pink line, really picks up. That speaks to one of our other themes, which is geopolitical fragmentation. Archit had it in his presentation as well. There is an ongoing reevaluation of industrial policy and rewiring of supply chains across the world. And we think countries like Mexico, India, and Indonesia are really well placed to benefit from a new multipolar world. So those are EM investments you can take advantage of, even in light of our underweight to the broad EM index itself. Okay, that was a bit of a whirlwind, but I'll just stop on the theme of mega forces. I think it warrants a bit of a deeper dive. It's our favored theme. And like I said, it's an investment that most obviously lends itself to the US tech sector. But again, you can get granular. And one way of thinking about that is in terms of a tech stack. So at the bottom level, you've got your chips, your servers, cloud computing, things like that. I mean, essentially hardware. And then as you go up the stack, you ultimately end up with those businesses that are going to benefit from AI to enhance productivity and reduce labor costs. So right now, the winners have mainly been in that hardware layer, especially the chips. But we think the opportunity set going forward is going to find is in finding those businesses where the impact of AI is underappreciated. And again, that's going to change over time. That'll be a rotating process based on just how much business models are evolving in light of AI and AI advancing. So I'll end there. I'll end on the theme of mega forces and AI, and I'll hand over to our next speaker.
Thank you so much, Neil. Just before Andy gets here, just a gentle reminder, you all would have probably a Slido, a QR code near your, where you're sitting. Please scan. You may see two tabs, one called Poll and Q&A. It'll be great for you guys to answer the poll question, and the Q&A then we can cover in the panel discussion. Here you go, Andy.
Thank you. Okay, clock is clicking. Okay, thank you everyone. Especially thanks Syfe for inviting me to be here to share my idea for this year. Okay, so my name is Andy Wong. I'm the global portfolio manager of LW Asset Management, and I'm also one of the founders of the logo FATA. That's our methodology. That's our BlackRock is called Factor, which means we are combining fundamental and technical analysis in our macro view. I understand that actually last week when I got the topic, I need to deep dive in the China and Hong Kong market, right? But what I'm thinking is, okay, actually there are some, of course, definitely I will talk about China, Hong Kong market, but I find out actually there's some mindset maybe useful for this year, and also not only applying in the US market, but also in the China, Hong Kong market. First of all, no matter what, for those who would like to invest, I think for this year, they always have a question about worrying about the future. Oh, are we going to have recession? Are we going to have structural problem in the region? So just make it as an example, recession. What kind of recession are you looking at, or are you worrying about? Is that something like this chart? Are you worrying about the dot-com bubble in 2000, or like the financial crisis in 2008? Okay, this is structural recession. Everyone was afraid of it. It makes sense because we're human. We don't love uncertainty. So everyone must usually remember, okay, there are 50 to 60% decline during those periods. However, if you're thinking about the term of recession, also is kind of an example. Like last year actually in Germany, there's a technical recession in May, and even, of course, because of recession or even blah, 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 those kind of different kind of noise, the market did a correction, which was only 11%. However, if you, because afraid of recession or those kind of negative news, you're focusing on the negative news, for the European market, for the DAX index, if you're looking at investing since last year, until now you got 20% up. So what I want to say is, okay, investment, definitely you need to face uncertainty, but not necessarily always thinking about structural big issue, those kind of big problem. So in this year, we believe, especially for Hong Kong investor, because our Hong Kong dollar are pegged in USD. And what we are thinking is the deposit rate, I mean like the interest rate is peaking. So maybe we still have some time to think about, okay, deposit maybe outperform a lot of things. But for example, if you look at the Hong Kong market, China Hong Kong market, is that valuation very attractive? I would say so. But if we are talking with some smart money investor or some people with smart powder, do you know what they are doing? They are calculating about the rental yield in Hong Kong. They are buying commercial real estate. So what they are thinking of, because they really just look at the numbers instead of feeling. But of course, there's one assumption: there's no another crisis. Okay. So I would say that in this chart, just an example, but the key thing for this year is you need to be more dynamic. Just like maybe in November, we long the longer duration fixed income, but we are taking partial profit in a January, but we are waiting for adding back medium duration fixed income. This kind of dynamic changes, this is something we may think about. This is just an example. And also in the equities market, if in general, I would say all markets, I would just put a neutral. Neutral as of like mid-single digit return. That's what my expectation. But depends on how you take the chances, like how what BlackRock just mentioned. Maybe there are some firms are doing nicer, and or actually I like equal weighting. In the long run, equal weighting is from my personal experience is more risk reward, getting higher risk and reward. So before I go to the US, before I go to China Hong Kong market, I was using US market as an example about our mindset. So no matter which market you're looking at, starting from last year, there is three very significant bottom out strategies. Earnings growth, bottom out, margin expression, and also the price action. So this is an example like what it's happened in the US market in the last few years. Starting from 2021 till 2022, actually the blue bar, which is the S&P 500 year-on-year growth, is going downtrend. And also with the operating margin in orange line and the green line, which is X top 5 operating margin. Actually, they were in a downtrend, just like what we did in the equity market. But starting from beginning of the 2023, depends on maybe you're looking at Max 7, then you may notice that actually starting from the Q2 of last year, actually is bottoming, which means stabilizing. If you are looking at the orange line and the blue bar, actually you could see that that's why since last year, middle of last year, at the end of Q3, we are keep mentioning in the media, saying that if the earnings is already picking up, actually the market should be completed 2 years consolidation period. That's why in the last few weeks we saw that US markets, there's a record high, blah, blah, blah. Okay, if you're looking at those non-mega cap margin, actually it's stabilized and bottom out starting from last quarter as well, 1 to 2 quarters behind the Max 7. So this is what we want to say is, okay, just look at relative term. You don't need to always look at the absolute term saying, okay, the earnings or the margin is not as high as before. So in terms of relative, actually, I think we have more opportunities in 2024. One of the reasons is, for example, like the Max 7, the white line, actually their EPS growth, the earnings growth, actually is going downtrend. Instead, the X Max 7, which means S&P 493, actually is bottoming out as well. Bottoming out is the key message what I want to deliver to you guys today. So, as I mentioned, we are using price action as well because this is real money instead of just research. And so, actually for the TA, the technical analysis, actually this is a very simple and I would say it's a standard TA sample. For example, like S&P 500. Please try to imagine. I try to mention this slide during this time. So it didn't happen in the middle of last year. So I was saying that, okay, look at the S&P 500. It matched with the earnings per share growth until Q2 actually did a breakout from the green downtrend line. And during that time, we were keep saying that, okay, the market probably is bottoming. And with the fundamental, finally it's bottomed out and it created a positive uptrend channel, okay, and until now, so you could see that actually everything is bottoming out, but also the price action. This is something what we believe from the fundamental and technical analysis, it matches. So what I want to say is from the experience last year, that, for example, do you remember what's happened during that time? Q1 last year, SVB, okay, and this is the time I just mentioned about the Germany index, the DAX index. It was 10% down because of the recession worry. Okay, but after that, the central banks, they are saying about, oh, they will provide liquidity, blah, 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 and the markets go up. There's lots of noise in the market. So what I want to say is, in the long run, I always think that actually for the investment, we can just make a kiss, okay? We don't not necessary to always capture all the noise, like flipping over. I mean, depends on your strategy, but I'm long biased in the long run. So I would say just a kiss is fine, but there's a bit of change. Kiss, usually people will say, keep it simple, stupid. But I would say you should be keep it simple, smart. Just like nowadays there's lots of smart beta ETF, factoring ETF, those kind of different investment tools, just like what we do. We are using fundamental and technical analysis as an example for you guys already. That's why, okay, due to the time limited, I'm not going to mention this and I cannot share too much of thing. But if you go to YouTube, you could find out we have soft launching a new channel, which is called Factor Investment Club. Okay, this is for today. What I'm thinking is for this year, quality is something, if we want to play safe, quality is something we are still looking at, like strong cash flow. And for the growth, it is very aggressive. It depends on, is that the market will be this will be no lending or blah, blah, but this is a tough one. So this is a risky one, so I prefer quality. And one of the thing is the ESG, but today I'm not going to touch the ESG part. But for someone who look at like COP28, and also if you look at yield is going down, actually I think the ESG theme should be bottom out as well. Okay, so just an example saying that, of course, we love AI, yeah. We prefer AI as well. But just like what I want to show is not our stock picking. It's about, we are just using what I just mentioned, the simple rule. Actually, you could also find out non-AI firm, for example, like the online education, like the Green Line, the MedTech, and also like the beauty company. Actually, you just have a similar return as one of the big AI chip company. So, but this is, we are just picking from, bottoming out from the EPS, margin, and price action, just simple way. So we could apply this kind of thinking, this kind of mindset into Hong Kong, China. Okay, for those who knows me well, maybe they may feel a bit weird. Okay, Andy, you have been underweight China, Hong Kong since mid-2021. Okay, yeah, that's true. Actually, because during that time, our model saying that is extremely expensive. And even positive news, actually our scoring actually was downgrading Hong Kong, China market. So nothing related to political, okay? But after a few years, right now, actually since last, December few weeks ago, when some anchor asked me, hey, what in the Hong Kong market? I said, I'm neutral. Okay, however, all the news, everything are very negative right now. But from the smart money, from my friends, actually they are buying, they are shopping around. So not only about stock market, but also real estate. Property market. So what I'm thinking is maybe this is a very good chance to make a midterm contrarian call. Okay. Of course, I'm not only betting on this. I'm going to share a bit as well. And you can see that actually I mentioned neutral not because of the last 3 days rally, not about the stimulus policy. This is something I already planned to talk about a few days ago. Okay. And one of the things, but we are still waiting for. Even neutral is important because do you remember I just mentioned about the recession? The recession in the U.S. market was 50 to 60%, right? And from the time being when I make a call saying I'm selling all of my Hong Kong China stocks, it down 48%. So if you look at from the top, from the peaking, and if you're looking from the MSCI China, actually, from the top until now, it's already dropped at roughly 60% something. So if you are looking at this kind of huge correction within 2 years, I don't think we should be too negative now. But we are still waiting for something to make us feel more confidence. For example, like fund flow. Okay, the fund flow, you could see that I'm not talking about the return from the blue line, which is emerging ex-China ETF. The red line is emerging market ETF, which has more China in it. And the green line actually is the EM ex-China ETF fund flow. And the orange line is the EM fund flow. So what we are waiting for is waiting for the orange line at least stabilize for 1 quarter, hopefully. Then we are waiting for the fund flow. Fund flow means foreign investor, how they are looking at us. And also, like we can see one thing actually is also seems stabilizing. It's about the China FDI. If you are looking at the year-on-year growth, actually the trend has been downtrend for almost 2 years, but seems stabilizing as well. So the thing, what I want to share is in terms of China-Hong Kong market, I'm not saying, okay, we will have a very nice picture like 2018, 2017. I'm just talking about relative term. You know, relative term, I think is kind of stabilizing and bottoming out, bottoming. Okay, but as we are waiting for confidence, what I'm thinking the key is the percentage what we are allocating. So for us, maybe 10%, but at least, I mean, for the risk and reward, I mean, it's worth to look at it. Everyone knows that we have deflation, right? Everyone knows that our consumption power is weak. Everyone knows that the real estate market is not strong at now. So what else we didn't know? That's the thing. That's why I'm thinking maybe almost the time to think about contrarian call. And okay, one last thing. I kept mentioning stabilizing. Yes, if you look at the China-Hong Kong market, if you look at last year, actually we are having 2 legs, right? 2 bottoms now. That's why HSI, if you look at 1 year, I mean, like almost half-year return, is drop. But if you look at longer term, it's 2 legs. So 2 legs means just like here. You can think about how about if this is a range bound for coming years, just like Japan. In Japan, if you look at 1989, from Nikkei, it takes around 2 years, dropped it from the peak. It takes around 2 years to drop 60%. And range bound for around 8 years. So what do you think? So at the end, what I want to say is, if we are not having crisis, if we are and the market is stabilizing, I believe the mindset what we are applying into a different market could apply in the Hong Kong market. Just like what we mentioned that in the media market, in the media, like the cell phone IoT company, the PC and data center company, and also even automobile glass manufacturer. These 3 picks, I think for someone who knows me from the media, they know that I did this kind of picking in the last few months. So actually, it could have some performance, but you still, I mean, it depends on your allocation to manage your risk. Due to the time, I think I will just share till now, and thank you very much.
So thanks, Andy. Would you mind actually coming back for the panel discussion? So I want to also invite Archit and also Neil back for the panel. So I see a lot of interesting questions, but before going to the panel, I want to kind of look at the word cloud for a bit and then see what you guys are actually interested in and what you actually invest in 2024 after listening to all these experts sharing. And obviously, there's some interest on AI on this. I'm not sure in which area, but yes. Yes. Okay. If you haven't submitted your questions, feel free. Maybe we can't answer all the questions, but we'll definitely reach out, and our advisor can answer more questions. So let's begin the panel. So first question, maybe we start with you, Neil. As a lot of audience here are interested in AI, right? So much of the rally last year in US market was driven by AI, we all know, right? And someone actually put 2 parts in the question. So one is like, what could be the driving factors for the rally to sustain going forward? How should investors look to allocate money into the global equity markets in 2024? And I think the second part is the most important, is given high valuations of AI already, yeah, is it still the theme to play for 2024? I can see that you like overrate AI, right? Obviously everybody's thinking, okay, it's already at a very high valuation. Should I still put some bets in AI in the new year?
Oh, sorry. Thanks, Andy. Cheers. Let me break that into two parts. Well, firstly, I agree with the premise of the question, which is, look, they're looking for opportunities. They're wanting to put cash to work. That all makes sense. But I think we need to distinguish here between the broad market being expensive and certain AI beneficiaries being perceived as expensive. Now, if you'd have bought Apple or Facebook 10, 15 years ago, you would have heard people say, oh, that's an extremely expensive stock. But, I mean, look at the earnings since then. That's essentially the same case we make for AI beneficiaries, which you can isolate and you can buy either through a thematic ETF or through single stocks. But we'll contrast their prospects with the broader index. Now, the broader index is on 22 times forward earnings. It's more or less what it cost 2 years ago. And if you took anything from that economics lesson that I tried to give just a minute ago, you'll know that we think that the earnings prospects for the broader index are not as rosy as they once were. So you're paying 22 times 2 years later for a market which now is competing with, 10-year treasury yields up 200 basis points. Like, that just doesn't feel like a good risk reward to us. So we stick with the AI overweight and underweight the broad index.
Cool. All right, thanks, Neil. And actually, there's another question about AI, but I will reserve it for a little bit later. Or Andy, you also want to share something about AI? There's a question, actually, I look at that, it should be for Archit, and it seems that some of you are actually interested in Syfe, right? Like, obviously, we are a digital investment platform, right? And with all the backdrop shared by you, Archit, and the other guests, what are the kind of portfolios or products that we should invest in 2024? So we're actually asking the poll question that we asked you and asking back on the panel. So Archit, maybe this one you can answer.
Yeah, actually, we were preempting this, so potentially there's a slide around it. Okay, yeah, cool. So I think I'll bucket into three things, like equity, fixed income, and the mega trends. So within the equities, as I think Neil mentioned, overall being underweight, I think there effectively we have our core portfolios, what we call as the traditional defensive growth balanced equity 100, like equity 100 being 100% allocated to equity. There, I think these portfolios are positioned well for 2024. Especially like the way we construct these portfolios are multi-factor based, having a bit of tilt towards equal weighted ETFs, giving that small cap value beneficiary. So that, I think, one product which I think potentially for this year could be interesting. Last year and over a period of 5 years, it has pretty good returns, and because of the kind of the factor-based strategies that we use, it's been outperforming the benchmark. Then I think fixed income. I think this is like very tropical in a way that, as Neil was alluding, like the bar to beat that yield is becoming higher and higher for riskier assets. In that bucket, we have two solutions. One, what we call Cash Plus. It's more like an overnight cash saving solution where effectively there is no lock-in, lock-up. You can put your money, you earn a yield, you take it out tomorrow. So it's kind of like an equivalent to putting money in a savings account. There, effectively, the yields that we offer currently are 5.6%, pretty attractive. Again, a very high bar. But then I think the second one, interesting to mention, is the income. With all kind of whatever we have heard so far, with Fed taking that pause, irrespective whether the cuts happen too fast, too slow, or happens late. It is bound to happen at some point as the earnings and as that lag effect comes in on the corporate side. So given that, I think, and the attractiveness of the yields that the portfolios, even investment grades, high quality products are offering closer to 7%, as the rate cuts happen, when it happens, these portfolios are going to have advantage over a bit of capital appreciation coming from there. And even if the rate stays longer, you're getting a pretty healthy yield there. The last one, I think, again, mega trend. So under our thematic bucket, there is one portfolio which is disruptive technology. And actually, it goes very well with what Neil was mentioning about that tech stack. The bottom, like the hardware side, where we have, so our portfolio it comprises mix of 6 particular buckets. Some of them include cybersecurities, esports, cloud computing. So it's not just the traditional or the hot AI. It's a much more well-diversified way to play it. And still astonishing returns over about close to 48%. So I think those 3 pillars potentially, we believe, could help, and whatever we have heard so far, could help to navigate 2024.
Thanks, Archit. Very structured summary. And Neil, talking about product in 2024, anything you think in particular you want to highlight that might be of interest? Like,
you mentioned product. I think, Archit, you were just talking there about the cash yields on offer and some of these money market funds. I mean, that's true. There's been a big move back into these money market funds, and there's debate over when these rate cuts are going to come, but safe to say they will trend down. And when that happens, I think some investors perhaps will wish they'd locked up the money at a higher rate slightly earlier. So we've got some fixed income products called I-bonds. It's just a way of locking in that yield now. Think of it as a fixed term time deposit, only one that you can get the capital back if needs be. So something like that seems to make sense if you are slightly more risk averse and you do want to lock in some of these yields now.
right, thanks, Neil. So apart from AI, I guess everybody, you can look into fixed income. I think there are a lot of different options. The next question I think I can ask Andy. Actually, I think a lot of the audience are still very interested in the China-Hong Kong perspective that you just shared. Similar to what you just shared, but they are saying that, okay, Chinese equities have underperformed global equities significantly over the past 3 years, right? And well, they actually use a term, interesting, right? They said many investors are now worried that the China economy will have what they call a 3D challenge. 3D, right? 1D is deflation, 1D is debt, and demographics, just like what Japan faced in the past decades. So actually, they want to understand more how you're weighing like China in your portfolio. Like I guess they're looking for more details on how you're seeing that, right? And you have some perspective share, but a little bit more deep dive then.
Okay. Okay. I think one of the key is the allocation, like how many percentage of we are trying to bet on it. And I mean, we are neutral in Hong Kong market and also, I mean, China market as well. Just like as I mentioned that when we compare to the Japan 30 years problem, lots of foreign investors taking it as an example. That's why we also look at how's the price correction. As I just mentioned, Nikkei had 60% decline in 2 years. It's very similar to MSCI China. And okay, so this is one of the backdrop. And another backdrop is during that time, Japan was suffering from the very strong yen. But what I mean, right now in China, actually the RMB is weakening instead of like instead of strengthening. I think this is one of the thing is key difference. And the third thing is actually if we look at the market, I think we need to be like very maybe we cannot just look at the beta. We need to really look at different sectors because just like what I did in the last 2 weeks ago when I went to a GBA alumni event with my UCSD alumni, actually we could there separate two types of people. Like for those who are working in financial market, real estate market, Their face is very gray. But for those who is looking working in those like new technology company, like battery company and even EV company, they are very bright. They are having very bright future. So this is something I think if we just talk about China Hong Kong market is a mixture because like HSI or MSCI China, you need to look at their component. But long story short, what I want to say, just focus on, let's say, for example, like HSI, I would say it's different component. If we look at high dividend sector, it's maybe great because we are still in a like kind of a deflation scenario. And SOE reform in the last few days policies announced that. And also another thing is people worried a lot about the real estate property sector. Right? But the thing is, if you compare like half a year ago, when people talk about real estate, I mean Hong Kong property market, and when those people check about the NAV and blah 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 the valuation, they feel like okay, there should be some more correction. Okay, that's something I remember if I remember right. So actually, what happened in the last few weeks actually is just priced the back what's supposed to be from those people who mentioned. So what I want to say is, if we look at the rental yield, even residential market, if you look at the rental yield right now, is 4 to 5%. Okay, but if okay, the assumption is there's no another crisis. Okay, the thing is okay, if that's the case, if we look back for the Hong Kong market. In the last 20, 30 years, if we take every 10 years as an average, usually when the rental yield touch 3%, they are getting smart money to jumping into the market again and again. So now it's 4 point something. So I think that's why there's some people with dry powder shopping around. And okay, the last thing is about the Hong Kong market. What I want to say is, I kept mentioning that the key point is neutral. Neutral is enough for a market to justify how they really think about, okay, the valuation, is that P, right now the estimate P is 8 times is cheap or not, or is reasonable. Anything, it's just like what happened in the US market last year. Until Q3, why suddenly people thinking is more positive? It's not only about earnings EPS growth, because they are thinking, okay, the interest yield is already kind of stabilized. That's why stabilizing is the key point, and relative term is something what I want to mention. So I'm saying I think 10% is a good bet for us. That's what we are planning to.
Yeah, good. So, Neil, you want to?
Well, Kevin, can I just supplement my
Sure.
previous answer? I mentioned I bonds and the appeal of fixed income. Bonds are back, sure. That's for your more risk-averse investor, perhaps. But Andy just mentioned how happy people who work in the EV industry are, and you can benefit from that as an ETF investor. We have a bunch of products which play into some of these themes I was talking about. So, supply chain rewiring, industrial policy, sustainability. And the thing that came to mind, Andy, when you mentioned EVs was metals and mining, lithium batteries, things like that. So a lot of those stocks would have also been, some have been bid up, but equally some, especially on the mining side, have been beaten up over the last 2 years, offering some pretty solid dividends. And as yields come down in fixed income markets, I think that's going to start to look really appealing.
Neil, seems that you're predicting the question from the crowd, Siva. Someone asking about the other mega trends, and I think you're predicting the question. Yeah. So I would tweak that question a little bit, because originally that question is about, okay, how would you see like EVs, green hydrogen, like ESG theme, like in 2024? But I will make it even more difficult for you, and because I also see there's another question on Bitcoin, but in the interest of time, so I will ask you like, okay, compare with AI, right? There are different like mega trends, like the ones that you mentioned, the ones like EVs and those I mentioned, even Bitcoin. I think there are multiple Bitcoin ETFs launched recently. Obviously, I want to ask how you would rank them. Or how would you compare, the investment potential opportunity around these?
Sure.
Like
Okay. Well, I'll touch on that point in the investment potential, and I think this really speaks to a benefit of rules-based index ETF investing. I'll pick up on a point I made during the main presentation about the beneficiaries of AI. So, like I said, so far it's been that bottom level of the stack. It's predominantly been chip manufacturers. It's been chips. Now, potentially, it could end up being in 5 years one of the major beneficiaries is a healthcare company. I mean, this technology really is in its infancy in terms of the adoption and the use. So, with an ETF, with an index, with a really rigorous methodology, you're able to capture those potential beneficiaries early doors across sectors. So I think that's something which is really going to appeal to people as they start to appreciate just how transformative this AI technology is.
Yeah, thanks, Tim. So, in the interest of time, I would ask the last one. I think not all the questions could be answered, but feel free to reach out to the speakers and maybe after the event to our advisory team if you have kind of further questions. So the last one with the interest in AI, right? Someone brought something very interesting. I think because today we have a mix of different audience from different backgrounds. So someone is aware that AI, apart from being a theme, right, is being used by different institutions in the portfolio construction. And they're thinking about the future of investing. Would that be even driven by AI? Will AI be able to find the alpha, right, that is like being there, I guess, right, for some of the institutions that are using AI to assist the portfolio construction process. So the question is, would the alpha diminish over time as more and more people start to use AI in the portfolio construction, right? And I think this question I'll open up to whoever will have insights. Anyone want to?
Okay, maybe I go first then. What I'm thinking is for AI, of course, definitely there's some winner, definitely. But for me, it's more treated like as an active investor. So as I'm long-term ETF lovers, so what I'm thinking is the alpha will diminish. So maybe in the long run, I mean for the AI investment is just another kind of active investment. So majority, maybe it's passive investment in ETF, maybe could still the majority for me, especially like having multi-factors or like having the smart beta ETF filtering the quality of the company could benefit in the long run. So just like what I mentioned, unless you want to capture or trade all the noise, if not, in the long run, actually everything could be simple.
Great, thanks. And Archit, seems that you also have something.
I mean, I'll supersede a bit. Like I think, quantitative investing has been there for decades and decades, and generally it's based on data. I think yes, with AI access to data, with the internet around, that access has become easier globally. But I think the key there, as always, is how do you remove the noise out of that data, and I think there you can't get around without having a professional who understands the key components and kind of make it cleaner for the adaptability.
So you'll be hybrid, you're saying?
Absolutely. I think yes, AI adoption there'll be a lot, and we've already started it within Syfe using it for some of the mundane tasks, putting together research, technical analysis, and market insights for clients. But I think the portfolio construction, which was the question, I think will always probably, in our view, still need a human touch.
Right. I might make just a more broader point on this. I think the dispersion we're going to see is actually going to be greater, and that's because of some of these more fundamental reasons that I mentioned: higher interest rates, higher inflation. We're no longer in an environment where a rising tide carries all boats. So we're going to see greater dispersion, greater difference in returns across companies, sectors, and geographies.
Great, thanks. Thanks, Neil. Thanks, Andy. And thanks, Archit. I want to leave more time for everyone to network and enjoy some drinks. And there's only one last thing, last slide, right, as the event approaching the end. If you have any questions, WhatsApp us. So there's QR code, we'll put it there. And then if you want to know more about us, download the Syfe app, right, register, and then get some offers. And also, I think we have a very important thing. We want your feedback. We'll be running more these kind of events, right? So we have a QR code on the table around the post-event survey. There are some questions there, only 3 or 4 very simple ones. So make sure you scan the QR code while you're chatting and networking with everybody. So now, I guess then we would ask everybody to grab a drink and enjoy your evening. Thank you very much.